Some breaking news. For the first time in 15 years, the Nasdaq has hit 5,000. This is a level that it has cracked only 7 times in its history, closed only 2 times above 5,000. You'll, of course, know 5048 is the classic all-time high from March of 2000. Biggest gainer since then, Monster Beverage, Keurig Green Mountain, Tractor Supply, Gilead Sciences. This has been in the making for a while, and we'll see whether it holds, but not an insignificant deal that we've crossed that line.
David was actually telling the story of how he remembered being at the highs of the Nasdaq, David.
Well, March 10th, I do remember that, of course, 15 years ago. Hard to imagine in some ways. Interesting that Yahoo celebrates its 20th anniversary today, of course. That era certainly was one highlighted by the move up in market value of the likes of Yahoo and eBay. Netscape for a time before, of course, it got acquired. And then the big deal of all, AOL buying Time Warner, and then the big whoosh. Remember that one, Simon? I guess you probably do, don't you?
I certainly do.
Straight down from that high on March 10, 2000.
The down leg and everybody saying, sit on your hands, the market will come back.
I find it interesting that
they were right.
Well, they did, but it's 15 years later.
Yeah. two biggest percentage winners are actually beverage companies. You think a lot about tech stocks as being in the race. Apple, obviously, in the top 10. But the beverage companies, Monster and Keurig.
Yeah.
Let's send it over to Bertha, who's at the Nasdaq with a little more color on this major milestone. Bertha?
Yeah, Sarah, that's one of the things that's very interesting when you look at the makeup of the Nasdaq composite. Back in 2000, the consumer-oriented stocks were maybe about 5, 6, or certainly less than 10%. Now they make up more than 20%. Granted, a lot of them are tech companies like an eBay, like an Amazon, but you do have those monsters on there, and Monster Beverage and Green Mountain Coffee. Keurig has certainly been one of the biggest gainers over the last couple of years. Those stocks regularly at all-time high, not to mention retailers like Costco and Ross Stores, the discounter that really has been a juggernaut this year. Another element that is a bigger weighting within the Nasdaq composite is healthcare, which is now up to about 16%. A good majority of that is made up of biotechs, but you've also had some big healthcare companies now listing here, the biggest, of course, being Anthem, the large insurer formerly known as WellPoint. You also have Walgreens Boots Alliance, which was formerly a retailer drugstore, but it too is moving in a new direction. So it's really about the fact that you're seeing these companies that are much more sophisticated, their valuations are much bigger, they pay dividends, which is something that a lot of these companies didn't used to do. Former Sun co-founder Scott McNealy, I spoke with him on Friday, and he was saying, we didn't pay dividends because we were a hardware company. We were building our companies back then. We didn't believe in paying dividends. We wanted to plow all that cash back into the company. But these days, you get a hardware maker like Apple that is in so many businesses, it just mints cash. Even as it plows it back into the company, that cash hoard continues to grow. So it is quite a different thing. And David, I could match your memory of Yahoo being here because I started just about 15 years ago today as a reporter on this new Yahoo Finance webcast, which was so early at the time. I used to say that about 13 people used to watch us because not that many people had broadband speeds to really be able to watch that in real time during the day.
Yeah. 15 years goes by very fast, I've noticed. Yes, it does seem to. But again, of course, that period of time typified by so many companies that really didn't even have an earnings for a PE ratio. And the PE ratio, to the extent there were earnings, was far higher than anything we're seeing today. Hundreds and hundreds of companies eventually going bankrupt as a result of business models that relied on them to hit the capital markets to continue to fund this hoped-for growth and eventual earnings. And when time finally ran out on them, they ran out of time, and that was that.
Hey YouTube fans, I'm Landon Dowdy from CNBC. Thank you so much for checking out our channel. You can subscribe by clicking right here to check out the latest Mad Money CEO interviews, market news, financial advice, and product unboxing. Enjoy!